going to have our section that we consider our revenue section, all the money we've made. Our expense section, we're going to break up and we're going to split it. We're going to have everything we consider operating expenses. So things like livestock purchases, labor, repairs, supplies, seed, feed, etc. Those things that are operating expenses. And then we're going to split out our interest expenses into its own section. You'll see later as we start analyzing our income statement that it's necessary to have interest expense separate from your other operating expenses, because that helps us analyze and evaluate it according to some returns that we want to look for. So we do keep those two items separate. So we have our total operating expenses here. We have our interest expense section with total interest expenses here. And then we'll come down and we'll have our total expenses, which includes operating plus interest. Our net farm income from operations is the amount of profit we've made from operating our business. Prior to anything else that's been sold that's considered not operating items, but it's outside of that, it's something like machinery, equipment, buildings, land. Those capital assets I might have sold, I'm going to leave those down in their own section at the bottom. So my net farm income from operations is simply total revenue minus total expenses. But when I have sold something, like sold a piece of machinery, or maybe I sold some land and I have a gain or a loss on that, I do want to include that. So I'm going to have that in its own section at the very bottom, and then finally I'm going to add that to my net farm income from operations in order to find my bottom line net farm income. So let's go ahead and think about what it means to have a gain or a loss. A gain or loss, again, is something that has occurred where I have an item that's not an operating piece that I sell regularly. It's not a current asset that's just going to be quickly purchased and sold or produced and sold or anything like that. This is capital assets. So again, those categories are going to be machinery, equipment, land, or buildings. Okay? So we're going to focus on those type of activities and the things that have happened with those. As I consider that, here's what I'm going to need to do to see if I had a gain or a loss. When I purchased a piece of equipment, I did not put it in the expense section of my income statement because it was a big purchase. I don't want that in the expenses. I depreciated that asset while I used it, and then when I sell it, I don't put the full sale price up as a revenue item because, again, that would be a big item, and I don't want to include that. So what I'm looking for is the difference between what I bought it for and what I sold it for, less any depreciation that has occurred since I've owned it. So what I'm going to do to find a gain or loss is I'm going to take the purchase price, and I'm not going to include that on my income statement originally when I purchase it, but I am going to look at that gain or loss after it's been sold. And so consequently, what I need to figure out is I need to find the book value on my asset after it is depreciated. So if it is machinery, equipment, or buildings, those items depreciate. I need to subtract their depreciation from their original cost to get their book value. If it's land, land does not depreciate, so its original cost is its book value on my books for the moment. Okay. So as we start thinking about how we're going to compute those capital gains or losses on the sale of capital assets, what we're going to do first is find the book value, and we're going to take costs minus depreciation. Then we're going to compare that to the selling price. So our selling price on this asset that we've sold, whatever it happens to be, we're going to have that gain or loss be the selling price minus the book value. So let's take an example. Let's assume that we had an asset that we originally purchased, and we purchased it for $11,500. We're going to sell that for $11,500. So this is after the asset has been bought, used, and now we're selling it. So we're ready to put it as a gain or loss because we've sold it. So we sold the asset for $11,500. Originally we bought it for $14,000, and we've taken $5,000 in depreciation on it over the course of owning that asset. So the first thing we want to do is we want to find the book value on the asset first. So the first thing is to take that original cost of $14,000 and subtract off that $5,000 that we have in our depreciation. And so that's gonna give us a book value on this asset of $9,000. We wanna compare that book value to the original selling price. And when we compare that to the original selling price, we can see whether or not we've had a gain or a loss. Well, we sold this asset for $11,500. We originally had purchase minus depreciation of a book value of $9,000. So I'm going to take that $11,500 minus the $9,000, and I'm going to see that I have a gain of $2,500 on this particular sale of the equipment that I had. So I'm going to show down in that income statement, in the very bottom section down there, I'm going to put in a gain of $2,500.